a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about value ETFs, and we are talking about value ETFs that are ultra cheap, suitable for very long-term investing. So we know that value stock have made a strong comeback. Growth outperformed value over the past decade because mega cap tech stocks did so well. But over the past year, a little more than a year, value stocks have started outperforming. And in fact, the Russell 1000 value index outperformed the Russell 1000 growth index by 21% last year, a big gap. And it remains to be seen whether that can continue because growth stocks have kind of started rebounding this year. They were beaten down, but it depends on the earnings season. And we saw from bank earnings that many CEOs warned about a potential economic contraction, and if that happens, value may continue to do well because growth stocks are hurt by higher rates when interest rates remain are kept at high levels by the Federal Reserves, because that means a bigger discount to the present value of cash flows. So looking at the very long term, value stocks outperformed growth stocks by almost 4.1% annually in the US, and that is according to Dimensional Fund Advisors research. So now most value companies are mature, dividend-paying companies that are being favored by investors currently. So that is another reason to look at value ETFs, and these tend to hold up better during periods of rising rates and high inflation. So we are highlighting three very low cost value ETFs, very popular too. So the first one is the most popular value ETF, the Vanguard value ETF, ticker symbol VTV, with over 100 billion in assets under management. It tracks the RUSV US large cap value index and uses the ratios of book value to price, forward earnings to price, historical earnings to price, also dividend to price, and sales to price, and then uses those factors to weight the holdings. Ultra cheap with just 4 basis points expense ratio. To learn more, you can go to the quote page on Zacks.com, read our research report articles, use the link to go to the Vanguard webpage for this ETF. You can learn more about what it holds. So 340 stocks with a P ratio of about 16.1 times, price to book 2.7 times. And looking at the holdings, Berkshire Hathaway, Warren Buffett's company, United Health, Johnson & Johnson, ExxonMobil, these are the top holdings. Looking at the sector exposure, healthcare, financials, industrials are the top sectors in this ETF. Then energy comes at number 5, consumer staples, and then energy. The second one that I'm highlighting is by State Street. It is the SPYV portfolio S&P 500 value ETF, ticker symbol SPYV. So as the name suggests, it holds the value stocks selected from the S&P 500 index, which have the highest value scores on the basis of book value to price, earnings to price, and sales to price. This follows a market cap weighting and same expense ratio, ultra cheap, and 16 billion in assets under management. I have selected these ultra cheap ETFs with expense ratios of just 4 basis points because if you're investing for the longer term, then expense ratios also matter. So cheaper ETFs will give you higher returns over the long term. Now, again, you can go to the quote page on Zacks.com and you can use the link to go to State Street web page. So you will see that top holdings are slightly different because it tracks a different index. Microsoft is the top holding, Berkshire Hathaway number 2. Then you also see Amazon, Meta Platforms among the top holdings because these stocks were beaten down so much last year that they have become value stocks according to those metrics. Looking at the sector exposure, also you will see those differences. So financials is the top sector. Then you will see information technology, which was so different from the VTV ETF, and industrials is the third largest sector. The third ETF that I'm highlighting is by iShares, ticker symbol IUSV. Now, it selects value stocks using the same ratios from the S&P 900 index. So, S&P 900 index is a combination of the S&P 500 index of larger cap stocks and S&P 400 index of mid cap stocks. So, this ETF will have slight tilt toward mid cap companies. This follows a factor weighting schemes, same expense ratio, and 13 billion in assets under management. Again, to learn more, you can go to the quote page on Zacks.com and the external homepage. Let's see what this ETF holds. So you will see the same holdings because it uses the S&P 500 and the mid cap index. So same top holdings, but slightly lower weights because this is more diversified and a little bit less top heavy than the earlier ETF that we talked about. But you will see the same sectors, slightly lower top, lower weighting in those top sectors, but very similar. The last two ETFs are quite similar. On the third slide, I have the comparative performance versus the S&P 500 index over the past 12 months. And it surprised me that all three ETFs had done quite well and almost similar performance, down about less than -2% over the past year, whereas the S&P 500 index was down about 13% over the past 12 months. Since we are talking about very longer term, I looked at the 10-year performance as well, and VTV was the best performer, very close to S&P 500 index. But as I mentioned, growth stocks outperformed the value stocks over the past decade. So S&P 500 index had a slightly better performance, and then the other two ETFs delivered quite similar performance. And in full disclosure, I own the VTV ETF, the Vanguard ETF, and the ETF investor portfolio that I manage. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer, and make sure to subscribe to all our videos so that you do not miss anything. And I will see you next week.